Good afternoon and welcome to International Certificate in Financial Service Risk Management Module 1. I see we've got a lot of people from yesterday who are on Module 2, which I expect, but good morning, good afternoon to Chris, Claudia, Isabel, John, Kenneth, Margarita, Ray, Rito, Richard, Royson, Sylvia, Stephanie and Suzanne. And maybe we've got more to go. Yeah, you're here again, Rito. So, you know what I always say at the start of these webinars, tell me what the weather's like, where you are, what the weather's like. What's it like in Hong Kong today? John, in Thames Ditton, it's sunny. It's blue sky, it's sunny in Thames Ditton in Surrey in England. It's blue sky and sunny. And also I'd be interested to know where you're calling in from. I work in a home office. So I would say I was on home. I don't have an office. But are you in the office or are you at home? Let me know. Let me know. Maybe depends what time of day it is. I suppose in Hong Kong it must be, what is it, 8 o'clock at night, is it? Home since March, Rito. Celia from home, Massachusetts. Oh, lovely. Yeah. Okay. Big day in Massachusetts, or big day in all of those dates. Yeah, 8 o'clock. And it's sunny in Nairobi, is it, Kenneth? Oh, lovely. Cold. Sylvia's cold. Where are you, Sylvia, again? Good. Okay. Sunny in Barbados. Claudia, you're not in Barbados. She's pretending you're in Barbados. You are in Barbados. Brilliant. Home tonight. Yeah, 8 o'clock. Nice evening. British summer. Okay. Birmingham. How's the weather in Birmingham? Sunny in Sussex. It's grey. I know. Good. I should do that. I'm laughing at Claudia who says sunny in Barbados. We should put up where are we and where would we like to be? Okay, but we'd obviously like to be here, wouldn't we? Doing the final webinar on Module 1, Certificate in Risk Management Financial Services. And so those of you who were here yesterday, it's similar to some degree, but we're doing Module 1 rather than Module 2. I did promise those of you yesterday that I was going to send something out on Module 2, and maybe even though you didn't come yesterday, you should have got it. Have you got an email from the IRM this morning with some model multiple choice questions in it? Have you? No email, I'm sorry. Not yet. Okay. No? Okay. Well, I sent it to the IRM this morning. And I asked that it went before today, but it doesn't matter. We've just got another month before your full webinar, but I just thought I'd do that. So I am going to send some more practice questions on Module 1 as well. So what we're going to do today, in the last webinar, we did units 1 to 4. I just gave you an overview then. So we'll do units 5 and 6 of Module 1 today. A little bit of talk about revision and exam technique. Obviously, it's the same formula of exam as Module 2. And then we'll have a bit of practice of some questions. So Unit 5 in Module 1. This is the essential reading. You're in Postwick Donoghue and you're in Hopkin. And you're in the Orange Book. And really when I looked at, as I say, when I was doing my practice questions for you all, this often refers to the Orange Book back in 2004 rather than the updated Orange Book. So I'll kind of stick with the Orange Book 2004 for your revision. I know it seems a bit daft because probably that's what the examiners are going to pick from. Yeah, when it often refers to the Orange Book 2004, chapters 4 and 5, as I say. And then you need to look at the PRA rulebook, which is a link, of course, on their capital requirements and internal models. So this is around risk analysis, moving on from risk identification to risk analysis. And what are the 6 reasons why we analyze risk? Okay, maybe, yeah, Royson, yeah, you're going to get MCQs for module 1, 2. Yeah, again, I don't know how many is there them. I've just done part 1 and part 2 questions. Maybe there's, don't know, 54 maybe. So you've got a few more, and obviously specimen examination guide you've got, and also the assessment questions at the end of every chapter are worth doing again. So Helen says, minimize losses, identify and implement controls, prioritize, definitely, Chris. Yeah, we've got all these risks, we've got to decide which ones we're going to focus on. Yeah, so we've got to prioritize our risk treatment, which do we control, which do we focus on. We've also got to compare our risk with our risk appetite, identify which ones are outside our risk appetite, and then obviously when we treat them, we're going to bring them back within our risk appetite. Achieve consistent perceptions of significance. So Hopkin talks about the significance of risks. Informed decisions. We can't throw all our resources at every risk, so we've got to decide how we allocate our resources. Sometimes we're doing it on a project, we're doing risk assessment on a project, and obviously one of the reasons that financial services organizations do risk analysis to ensure we have adequate capital to withstand shocks, and that will be a regulatory requirement. Good, so that's a list for you. So risk analysis, we're going to analyze our risks in terms of impact and likelihood. And then there's always some discussion, and it is always difficult when you do risk analysis and you ask, take a very simple aspect, a non-financial services aspect, and say, what's the risk of your building burning down? And people will say, yeah, well, do you want me to talk about the building burning down if it doesn't have sprinklers, or do you want to talk about the fact that the risk of the building burning down given that the building has sprinklers? So the inherent risk is the risk, the size and likelihood of the risk without controls. And then obviously what you're trying to do is use controls to reduce the likelihood and impact of that risk. And it's always difficult to get people to think about the inherent risk when the controls are already in place. So Hopkin talks about inherent risks without controls, the current level of risk, which people can normally get their head around, and their target risk, which may be lower in terms of impact and likelihood. So we've got controls in place, but we need to put in an additional control 2, to bring our risk within our risk appetite. Yeah, and we've always got to try and analyze when is the cost of the additional controls going to exceed the benefits of reducing the impact or likelihood of the risk occurring. So in terms of risk analysis, Hopkin talks about benchmark tests for risk significance, and back to this acronym FIRM. So we're in revision mode. So what does FIRM stand for? Can anybody have a guess? Financial infrastructure. Okay, what about R? Anybody for R and M? Reputation and market. Oh, well, you're good. Okay, that's good. So Hopkins says, look, you can use a firm risk scorecard, which we've talked about before, and then we can introduce benchmark tests for significance. So we're not going to worry about risks which are small. Yeah, we only want to concentrate on risks which are significant. So what is a significant risk? So financial might be anything which has an impact on the balance sheet of more than 0.25% of the assets. Infrastructure might be disruption to normal operations of half a day or more. Reputation might be share price falls by more than 10%. Marketplace might be impact on balance sheet of 0.5% of turnover, or whatever. So we've got to, that's what Hopkins is saying about significance of risk, saying, before you do risk analysis, you've got to decide how much time you're going to spend on each risk. And so you need to judge the significance of the risk. And you can use a firm risk scorecard to do that. And then, of course, Solvency II and Basel III do allow banks and insurance companies to use their own internal models to quantify their capital requirements in Pillar 1, and even in Pillar 2, you're encouraged to use your developed models to quantify your risks over a longer time horizon. So what are the benefits of an internal model? It helps ensure a firm uses a comprehensive risk management system, incentivize the firm to improve their own estimates of risk exposure. And most firms like internal models because they believe it more adequately reflects their own risk exposure rather than the kind of using the regulator model. And that can often mean they hold a lower amount of regulatory minimum capital. but it is costly and time consuming, as anybody who knows, who's been involved in your internal models, working with the actuaries will know. So again, that's you're in Apostolic and Donoghue for a lot of that. And then in Solvency II for the insurance companies, if you are going to use your internal model, for the regulator to permit you to use your internal model, you have to satisfy these 6 tests. And then that's a list which you should always have in your revision notes. And then the unit moves on to talking about defining the upside of risk. So moving away from risk as a bad thing to risk as opportunity. So what do we mean by the upside of risk? I always find this a little tricky, if I'm honest. So what do we mean by the upside of risk? It's talked about in Hopkin. What do we mean by the upside of risks? Opportunities, Animesh. Yeah, it is about looking at the opportunities. So when we do a risk assessment, is it more like an opportunity assessment or something like that? So we're trying to present, it's really important, risk management. That risk management is not just something, a discipline which stops bad things happening to our organization. It's a discipline which can help our organization seize competitive opportunities. And that's what we kind of mean by upside of risk. And so, again, Hopkin talks about a riskiness index, and again, back to the firm risk scorecard. And basically, how can risk management reduce risk without affecting the strategy, tactics, operations, and compliance functions of an organization? So how can we do it? We want to reduce risk, but we don't want to inhibit the organization from achieving its business strategy. This is a definition. I put this in this morning. It might not be in the slides that were sent out by the IRM. This is a definition of upside of risk in Hopkin. So in the study guide, they talk about opportunities that can be seized with a desirable outcome. Then Hopkin talks about, we might have fewer disruptions to normal operations and greater operational efficiency because we've used risk management, or maybe seizing opportunities because our competitors can't manage the risk as well as we can. We may identify positive events during the risk assessment. We may identify opportunities, or sometimes we may achieve a positive outcome in difficult circumstances, and that all what Hopkin defines as upside of risk. And then there's a little bit about risk evaluation and risk appetite. And I suppose organizations are always trying to figure out what should we do next, and how much risk should we take in pursuit of those objectives, which is of course risk appetite. So we're evaluating our risks and always comparing and costing them to our risk appetite. Are they within or outside of our risk appetite? So here are some terms that you should have in your study notes. Internal model, likelihood, frequency, upside of risk, risk matrix, which you're going to come across to get more. And then here are some of the lists, a couple of Hopkin acronyms, and then some other lists that you should have in your study notes on Unit 5. So here's a specimen multiple choice question. I think I talked about these yesterday. We're trying to testing a list, aren't they? That's why I always say you're going to need it in your revision notes. You need lists. Which of the following are advantages for an insurance company of using a regulatory approved internal model to calculate their capital requirement? Is it 1, 2, 3, or 4? Richard's gone for C, Animesh has gone for C, Ray's gone for C. Royston's gone for C. Anybody else? 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. C is of course the right answer. Obviously, they can calculate part of the calculation. You can use a partial, you can use some of your internal model and some of the regulators model. You can use your internal model for underwriting risk and then use the regulators model for market risk or whatever, or you can use your internal model for the whole of the thing, of course. Good. When you look at these questions, this is not necessarily a thing. So the three which is wrong, they're not having to use a standardized approach. It says, well, you kind of don't use a standardized approach, but it's not the right answer. So you're always looking for the most correct answer and watch for any words in the question that's not here. Sometimes it will say, what is the best definition of risk assessment? The best definition, yeah? And you might look at them and say, well, they're not bad, and you've got to choose the best ones. So when you're doing the exam, really focus on the words in the question. Good. And then unit 6, which is a long old unit. So when you do module 1, you sort of going to do, and then the unit 6 is sort of about risk treatment, but also about other things. There's cyber risk, outsourcing risk has got a lot of stuff in here. So you know, you probably found that when you got to the end of the module, you thought, oh, this is a long unit. Again, you're in Foundations of Financial Risk, Postic and Donoghue, and you're in Hopkin. Again, you're in the Orange Book, and again, you're in the PRA Rule Book, but there you're looking at risk control and outsourcing. You also look at the Basel Committee, the Bank of International Settlements, work on liquidity risk management, because we're looking at how we treat risks, including liquidity risk. And then they also refer to this McDonnell FSA publication, which is pretty old now, December 2002, regarding the failures of EU insurers. So I expect most of you are familiar with a risk matrix. Who has never seen a risk matrix before they did this module? Anybody? Never seen a risk matrix? No, yeah, so they're a really common form of visual representation of risks. We're going to measure risk against appetite, impact and likelihood. Here is a 3x3 matrix. And once we've analyzed the risks and placed them on our risk matrix, we're going to try and move them, and we've enunciated our risk appetite in terms of impact and likelihood. Our object when we treat risk is normally to move them within our risk appetite. So you'll be familiar with some of this. Slightly less familiar is Hopkin kind of uses a similar model to talk about opportunity risks. And he talks about how when businesses are planning what their strategy, they should always be gauging potential rewards against potential risks. So you might be expanding into China, and that could bring you massive rewards, but you have to take a lot of risk. Yeah, and so he comes up with this 4 E's or 5 E's of opportunity risks. So make sure you have a note of all of those. And the 5th E is we exit if our risk appetite is exceeded. We think the risks coming out of the country we've invested in, for instance, are too large. And then they talk about risk control techniques. So they've got the 4 T's, and then we go with the P, C, D, D, D. Preventive, corrective, directed, and detective, the 4 ways we control risks. So here you go. Passwords, follow the bank's procedures, bank reconciliation, separation of duties. So you can decide whether passwords, computer passwords, are preventative, corrective, directive, detective. So you're going to put passwords P or passwords C or passwords DI or passwords DE. Yeah, and the same for the others. Have a look. Well, we put them in order. If you can be creative, put them in order. Which is preventive, one's corrective, one's directive, one's detective. So put them in the right order. Passwords. Well, is that first, Animash? You saying that's preventive? Or is that what you're saying? Okay. preventive. Passwords is preventive, we're saying. Is that what we're saying? PCDD. Okay, they are in order, are we saying? You're right, Chris. You're right, Chris. I've gone with the reading. And it's a good point Chris made, you know, a good point you made. Sometimes you might think, well, I don't think that, but the study guide says that. And unless the study guide is obviously wrong, be very careful, you know, when you come to the exam of going with who you think is right, because the examiners are reading the study guide. The examiner probably wrote the study guide. You might be going from the study guide. And so this is what the study guide says. Separation of duties is preventive, passwords are corrective, follow the bank's procedures is directive, and bank reconciliations are detective. That's what I got from the study guide. Okay, so this is so obvious for a examiner to examine. It's dead easy. You give you a control and say, is it preventive, corrective, or directive? Is it preventive, corrective, or detective? You can see how you can write a multiple choice question around it. So you will get one on PCDD, and you just need to be very clear or get good examples of what you consider in each. And then it starts moving on to how we control different risks within a financial service organization. And one of the risks that banks and to a less extent insurance companies have is, of course, credit risk. And so they come up with the 5 C's of credit risk that a bank primarily, when they're loaning money to customers, will look at when assessing the credit risk of their counterparty. Again, another list to learn. And then they talk about operational risk. And who's involved in operational risk? Let me know if I know somebody was involved in operational risk. If you put up, I'm involved in operational risk, I think quite a few of you are. So again, operational risk coming out of our people, processes, systems, external events. So a wide range of risks other than the market, credit, insurance, underwriting risks. And so we have a wide range of different kinds of controls in operational risk because there's quite a wide diversity of risks, from crime to conduct risk problems, people problems or whatever. So there's a wide range of different types of control we'll see in place for operational risk. And in the exam, if they're trying to ask you how to control an operational risk, you're just using a lot of common sense, you know, and thinking, well, what does my organization do to control the risk of systems failure? What do they do? And then they move on to insurance and risk transfers. So for people who are from an insurance background, this is easy. People from a banking background, obviously you may not be so familiar with insurance, and they talk about the different kind of insurances that banks or financial institutions, insurance companies will buy to transfer their risks to the insurance market. And they talk about first and third party risks. So in the chat, is number 1 first or third party? Yeah, which is number 1? Is it first or third party? So Chris is involved in operational risk. Helen, Kenneth, Animesh is involved in enterprise risk for non-financial institutions. Okay, so most of their risks are, of course, operational risks, aren't they? They're not. There will be some element of credit risk and some element of market risk in a non-financial institution, but normally small. First party, yeah. So number 1 is first party. Wilson works for an insurance credit rating agency. So you're looking at the ratings of the insurance company. So you're looking at their risk management, aren't you? And looking at all of their risks, including their operational risks. Operational risks are much harder to assess. However, operational risk can be transferred to the insurance market, often, not all of them. So the top risks are first party risks, the risks that our organization suffers a loss. And so banks and insurance companies will buy policies in case their building gets burned down or gets damaged by terrorism, or their business interrupted when they have a fire, or their employees steal their money, or they can buy cyber insurance, which may suffer business interruption due to a ransomware attack. Well, third-party risks, the financial organization causes damage to another party, the bank gives somebody bad advice, the bank systems are inadequate, and all their customers' data is stolen, and so the customers suffer breach of privacy and they sue the bank, or sometimes the shareholders might sue the bank's directors for falsifying their financial statements or whatever. So these are third-party policies bought by banks to protect their legal liabilities. It's going to pay the defense costs and any compensation that they have to pay to other parties who they've caused the loss to. So that's third party. So just have an overview of the different types of insurance. You don't really need to know much more than that. Again, it's dead easy to examine in a multiple choice. And then they move on to business continuity planning. And again, some of you in operational risk, I presume, will be involved in business continuity planning, because it's one of the principal operational risks in a financial services organization. And clearly, our business continuity planning has been tested when we've had to service our customers, and whilst all our employees have been working at home and not in the office. So it's been a big test of our business continuity planning over the past 7 months. And I know some of you early on were saying, I've got no time to study because we're just trying to get the business going. And so the key elements of business continuity planning are: you prepare for the emergency or the crisis, and then obviously you manage the crisis and minimize the damage, and then you recover from the crisis efficiently and respond effectively. And that involves normally some communications element with the media and all your key stakeholders, as well as steps internally to recover from it. And then business impact analysis, something we probably do before we've formalized our business continuity planning. We analyze the impact on our business if a certain function is lost. If our IT systems go down for 12 hours, what will be the impact on the rest of our operations? So that's a massive subject, which they're covering in about a page. So, and then they move on to outsourcing. So you've probably worked for an organization who's outsourced. So it'll be interesting if you put up in the chat here what your organization outsources. You know, in insurance, insurance companies outsource underwriting under delegated authorities. They outsource data to cloud management services like AWS. They'll outsource claims to loss adjusters. They can outsource everything apart from actually their capital. So it has been a feature in recent years that financial service industries have outsourced or offshored for these for various. Sometimes it's for expertise, sometimes it's to streamline operations, sometimes it's for better quality and services, sometimes because we don't have the internal resources. And obviously the regulator in particular is interested that the banks and the insurance companies do not increase their risk exposure by outsourcing and do not pose regulatory risk to their customers by outsourcing. And so there's normally expect some systems and controls to be in place, such as these, to make sure the operational risks in particular coming out of the outsourcing are monitored and managed appropriately. So these are some of the systems controls in for outsourcing. And then there's cyber risk. And cyber risk, I mentioned cyber insurance already, but cyber risk is massive nowadays for both banks and insurance companies. One, banks in particular are very digital operations, but insurance companies are becoming more so. Secondly, they have a large amounts of personal data, and there's all sorts, and obviously there's lots of privacy regulation around the world, which means that we've got to protect that data. So I was just reading this morning, I think in the newspaper, that there's been an increased level of cyber attacks following the virus. some state actors trying to access details of our vaccine program or whatever, but probably more criminals trying to target organizations, commercial organizations such as banks and insurance companies under the cover of the virus because people are distracted or they think there's easier routes into our systems because people are working from home. So these are some of the controls that banks and insurance companies have in place to prevent cyber risk, and it's a key regulatory concern because it affects all of the regulators' objectives, consumer protection, the risk of large-scale financial collapse, etc. And then it finally moves on to how do we learn from experience, which we did a bit in module 2 yesterday. When we have a loss event, we need to record it and obviously manage the loss event, but then we need to reflect afterwards on how it happened, why it happened, what its impact was, and how can we stop it happening again? What can we do to enhance our controls going forward? So these are some Unit 6 terms. So it's quite a wide-ranging unit, and these are some of the Unit 6 lists. Good. Any questions on Unit 2? Actuarial teams are outside Margaret. Web hosting, analytics, data storage. So Rita, so you're outsourcing an element of your cyber risk, aren't you? But you're retaining regulatory responsibility for it, and so you have to manage those those data storage providers. Marguerite outsources internal audit. Yeah, so you're outsourcing part of your risk management process, then, aren't you? New business and servicing. All right, okay. So you outsource some of the servicing of your business. So they're all good examples of how we can outsource quite almost anything, different bits of a business. It's not just IT outsourcing, it's a range of outsourcing. And obviously we just need to focus on how do we manage the risks coming out of there. Okay, so those who were here yesterday know what I'm going to say. You know, it's the same as when we started. You're moving into revision mode, hopefully. You got a month, you need a plan. When am I going to revise? I've got probably a lot of you I know are doing both modules. So when I'm going to revise, I'm going to do module 1 on unit 1 on Tuesday and module 2, unit 3 on Wednesday, whatever. You need a plan. And even if you get behind your plan because work and life take over, at least when you have a plan, you can see your behind plan. Be efficient. Which I often say is, you know, not multitasking, little and often you're studying, good notes and key terms and lists. And again, I think in the LinkedIn discussion forum, I put up all the key terms and lists, which I've talked about in the PowerPoint. Little and often, as I say, spaced learning, do a bit of study, test your recall, think how it applies. Again, there's a specimen examination guide, which you should download. I think, has anybody done the specimen examination guide on module 1? Don't know how you find it. I mean, somebody yesterday done the module 1 where you outsource vanilla. Yeah, okay. Someone yesterday had done the specimen examination on module 2. Is that right? Did all right? I don't know if they're here today. So have a look at the specimen examination. I think it's 28 questions. As I said, I'm going to send you another 50. I'm not going to send you any case studies. They're just going to be part A and part B questions. But certainly have a look at the case studies in the specimen examination question. You can use it just to test yourself originally, see how well you're doing, get a feel of the exams, get a feel of the questions and the types of questions. And then you can always come back to it and use it again later to see how you've improved. Obviously, you're going to do better the second time you've done it because you've done it already, but I think it's worth using more than once. And get your study notes together, decide how you learn best. And as I say, my secret of revision is normally to test yourself a lot. You've examined on the study guide, the TOR test and the essential reading. So you need to be in the relevant parts of Hopkin. Obviously, if you're doing module 1 and module 2, you're probably in most of Hopkin and most of Apostolic and Donoghue, but not all. Yeah, but you know, focus on which chapters in each unit which I've described. And then here is the essential reading. It's highlighted at the start of each unit. You will get multiple choice questions on these. The examiners are going to say, okay, I've got 60 questions. I'm going to take some from the study guide. I'm going to take some from Hopkin. I'm going to take some from Osposock and Donoghue, and I'm going to make sure I've got a question on each of these essential readings. So if you don't read them, you might struggle to answer the questions. Obviously, the PRA rulebook is massive, yeah, but you're only asked to read certain sections of the PRA rulebook. And sometimes what you'll find is what is in the essential reading is also in the study guide. So, you know, they might be examining you on the PRA rulebook, but actually the study guide is summarized what's in the PRA rulebook. But make sure you get into all of these essential readings. At the moment, I would park the additional reading. Yeah, hopefully you've read it, learned from it, helped your career. We're in revision mode. We've got to focus on the essential reading and the core text. Get your study notes together, key terms, lists. As I say, have a note of your additional reading, but as I say, you're probably just at this stage just think, well, okay, how does that help me remember or recall what's in the essential reading and what's in the rest of the module? And then test yourself. As I say, use a specimen exam, use a self-assessment questions at the end of each unit in the study guide. You can use flashcards, key lists, key terms. You can think of questions yourself. I think it's quite good to do that. You can come on the discussion forum and say, has anybody got any good questions? You can do that. You can test yourself under exam conditions if you want to. I don't think timing is a massive issue usually. I'm going to talk about that in a minute. And I'm going to send you another set of questions to test yourself. And I've set them out by unit. So you can do it that way. You can say, okay, I'm going to do unit 1 and then I'm going to do Neil's questions. Or of course, you could just do all 6 units in a row and get a sense of how well you're doing. Exam technique, same exam as module 2. 60 questions in 90 minutes. Section A, Section B, and Section C. Allow more time for the case study questions. Make sure you have 30 minutes for those. Reasons people fail, exactly the same as module 2. You can't just read the study guide. You need to do read the text and the essential reading. You do need to practice, particularly the Section B statement, assertion and reason questions, which we've done a few of as we've been through, and they're common to module 2 too. And then allocating yourself enough time for the case studies. Okay, let's have a bit of practice on some of these questions. So this is a Section A question. An inherent risk in lending means a bank can become skilled in lending to one industry, e.g. mining. How could a bank reduce such concentration risk? Is it A? Helen had a score of 19 out of 28. Okay, yeah. Okay, so yeah, it's early. You've got a month, haven't you, Helen? Probably just about a pass, but you probably need to be safer in the 20s. Royson, there's only one specimen examination question. What will be, I think, is that for module 1, which has been around a while, they will have a bank of questions, but they don't want to give them all away, so they only give you 28, and then they'll have 60 other ones at least or more probably, which they might use in the exam. So the additional questions you're going to get, the multiple choice questions at the end of each unit are worth practicing. They're in the same like Section A questions, and then I'm going to send you examples of Section A, Section B questions. Yeah. Okay, so Helen, that was back in April. So yeah, Sylvia, I'll send you the slides. I think IOM should have sent you the slides already. Okay. And Helen, you're right. You know, you just need, if you practice in June and you're getting back into again, it's probably worth doing again. You might score less than 19, and then obviously next month you're going to improve your score, aren't you? Okay, we've got 4 A's and 1 B, and it is A. Yeah, so they're trying to diversify. So they're going to buy non-related loans. Yeah, they're not going to sell non-related loans. They're going to buy non-related loans. That's a banking diversification strategy. And how might objective setting be a source of risk? So this is covered, the risks arising from objective setting. How much might that be? Rito says B. Animesh says C. Richard said C. Well, 2 I don't think makes much sense, does it? By being delegated. I suppose you might say if we delegate objective setting, the people might get it wrong, but it's not 2. So it's driving me towards C. By being misaligned to the objective organized business context. So our objectives are not aligned to the context. We've not considered the context we're operating as an organization when we set our objectives. So clearly that's a source of risk. And our objectives may conflict with our stakeholder interests. Clearly an organization is trying to satisfy as many of stakeholders as possible. And if our objectives conflict with what our stakeholders want, then that's going to be a source of risk because they're not going to be happy. So it is C, 1 and 4. And then this is the section B questions. Again, if you've been on earlier webinars, you've seen before. If you've been in a specimen exam guide, you've seen before. And also I talked about them yesterday. Here's an example. You've got to decide whether both statements are true, or whether there's one true, one's false, or they're both false. And if they're both true, you've got to decide whether statement 2 is a correct explanation of statement 1. Oh, we've got it good. We've got John's on B, Richard's on A, Animesh is on C. Oh wow, we've got controversy. Why do you say it's C? Why is it C? Because OERMN framework is a cube. Okay, it's true. But the top face reflects the risk management process. Are you saying that's false? What is the top face of the cube? You're right, Animesh, it's organizational objectives. So that's a really sneaky question. The front face is the risk management process. Yeah. The top face is the organizational objectives and the side face is the implementation process. So it's not a very nice way to test that. And so the correct answer is true, false. And here's a case study question. As I say, in your exam, you'll probably get 2 banks, 2 insurance, I would think. I need to read the case study normally. Takes time, so that's why you need to just leave yourself a bit more time for the 16 case study questions. Okay, quite a lot of contacts there, very specific contacts. The RGB are Renewable Green Bank. What do you think? Margarita thinks it's B. Richard's B. Helen's B. Ray's B. Yeah, you're right, aren't you? But it's funny. I think with the case study questions, you know, in some respects, you're going to get you've got to read the context, and that's important. But then sometimes the questions can be relatively straightforward too. Obviously, they're saying they're green, aren't they? And that means their investors might not want to loan money to an oil and gas company, which is 3. And obviously, when looking at our risk appetite, we need to consider the exposure of the loan in any case. So the correct answer is 2 and 3. It's not relevant that we've never had an ethical investment event. Obviously, we don't want to have an ethical investment event, but it's not going to help us. That neither trust or bank will be prepared to lend to you. Power is interesting information, but doesn't determine our risk appetite. So do you think RGB would lend the money? I don't know. I don't know. So correct answer is 2 and 3, answer B. Okay, so that's all I have for today. As I say, we'll email you out the questions and a copy of the slides. If you go to the discussion forum, you'll see I put in the comments, the units and the comments, I put in the various sort of definitions and key terms and lists that you need to have in your revision notes so you can recall them in the exam, the sort of thing they may test you on. I've talked about the fact that you need to be in the essential reading but not the additional reading, and you need to be in the study texts, core texts, Hopkin and Apostolic and Donoghue, as well as the unit, as well as the study guide. Yeah, Rito, I hope they arrive soon. As I say, I did send the questions off this morning on module 2. I've got the module 1 questions ready to go. I'll send them with the slides to the IRM now. If you don't get them, I mean, they're busy this week. Obviously, they're doing lots of webinars on all the different exams this week, but you should get them this week. Just drop them an email. Helen, that's a good question. I'll ask you, I'll have to come back to you on that. Someone must have had it before. I think if it's multiple choice, I imagine you do it on a computer screen. It used to be a written exam module 2, but module 1 was multiple choice. So I presume you're doing it on a computer screen. But you will be provided with paper that you can scribble on. Yeah. So, but it's worth checking with the IRM. Yeah. Richard has got the module 2 questions. How are the module 2 questions, Richard? Have you done them yet? You're right, Helen. Okay, so yeah, just check. But normally, obviously, it's really important you know where your venue is and what the setup is and what you're allowed to take. And so within the IRM exam procedures, you should be able to find most of that. And if it's uncertain, really ask them. Good. Okay, well, nice to meet you all virtually. We managed to stay within the hour, which I don't normally do I? And I think, make sure that your next steps, you've got your revision notes together, those key terms and lists that are talked about, your plan, your attack, have lots of practice. And as I say, if you do have any questions about the answers in the multiple choice questions I've sent you, I normally say this is the answer and I reference where it's come from, but I don't explain my reasoning for the answer. Then stick that in the discussion forum, or worst come to worst, go to the IRM. I'm not saying my answer is always perfect or my question is always perfect, but I'm just trying to, what I was trying to do was trying to get you into other bits of the book that you might not have been in, and testing yourself. I don't know the split, John. I'll ask. Yeah. I think there's more in A than B, but I don't know. I will see if I can find that out, John. As I say, I've just sent you section A and B questions. I've sent you 6 section A questions and then 3 section B questions, but I'm not, because I think that's roughly how it is in the exam, but I will try and find that out for you. Roisin, yeah, we don't know. It depends, Roisin. You know, I think if I was practicing, I would probably want to be up in the 80s, but in the exam you'll probably pass with 70. But it depends, you know. Sometimes when they adjudicate the exam, they think this is a bit of an easy exam, and they reduce the pass mark. And sometimes they look at it and think, oh, this is a hard exam, and they increase the pass mark. Sorry, and sometimes they think it's a hard exam, they reduce the pass mark. So there is not a definite pass mark. It will, John. Yeah, I'll try and get it for you. Yeah, it's not on the front of the specimen examination paper, I don't think. So I will see if I can find that out. Any other questions? So if I do find out, I'll put it in the discussion forum, or I will ask them to just add it to the email I'm sending to you. Good. Yeah, nice to chat virtually to you, John, too, and to everybody. As I say, it's a funny old time, and to the extent we're not socializing, maybe you've got more time to study, but also I know we get distracted from other things, or work may be really difficult at the moment for various reasons. So little and often practice, and you'll be fine. Good. I'm pleased you're feeling more prepared, Richard. That's part of it, isn't it? Really, it's walking into the examination and not being surprised that these use assertion and reason questions. Oh, I didn't know that one, or you know, and knowing how the exam's going to be, and have got used to reading different questions and figuring out what the right answers are. Good. Yes, nice to see you, Helen, or not see you. You know what I mean. Bye. Okay. Good afternoon. Have a good day.